Estamos listos. Okay, so good morning, everyone. Thank you for being here. Today we're going to be presenting our Capstone project, a full 2025 financial plan, in this case for Target Corporation. And as you know, Target is one of the leading retailer companies in the US with over 1,900 stores and a strong omni-channel strategy. Known for affordable quality and convenience, Target continues to grow every year by investing in models, tech, and sustainability. Well, in our project overview and objectives in this case, in this capstone project was to build or for example, simulate the real budgeting process a finance team would do for Target and what we will go through. And we forecasted things like revenue, costs, capital expenditures, and build a full income statement and balance sheet. Every assumption is based on historical data, real ratios, and a grounded understanding of Target operations.
So, like was said before by my teammate Gerson, we use historical data from the Target company, which was taken from the annual report of 2024. By that, we could make a sales assumption of how it is going to be the forecast of 2025 for Target. In this case, we saw that the total of 2,050 stores were going to be made on 2025. We multiplied by the visits per stores, giving us a total of how many total visits Target has in the year in this forecast. Also, we averaged the ticket per visits being $66, and we considered the total forecasted revenue of 115 million, 191 and 500. Also, we check out the marketing spent for Target, and we find out of the 2.4% in the total revenue, representing a $2.76 million. Now, in the next slide, we will see how the cost represents the revenue for Target. In this case, it's easier for me to explain to you that for the dollar that Target gains in any sales, the 72.8% will be in cost of revenue. We check this out with real data on other retailers worldwide, and normally, actually, they have that kind of cost of revenue in each product. Actually, it's just 72 cents per dollar, but here we find a small differentiator for Target. Next, we will see the expense highlights that we find out in Target. As I said, we took it from historical data of the annual report, and like that, with the financial ratios, we could find out and make these suppositions. This will be the selling and general administration expense, represented at 21.75 million, in line with inflation on the store base, and the depreciation and amortization, giving a total of 2.44 million. This was brought up with the historical trends that we saw. The US inflation is considered of 2.8. For today's year was 2.4, but this change was thanks to all the historical process that we took to get it make it more accurate,
Okay, talking about the CAPEX, we have to interpret that it's capital expenditure. So it's basically all the money that the company invests in material. We have divided into new stores, store remodels, technology, logistics, and sustainability. As you can see, we have the amount. So in the comments, you could see that Target yearly implies 20 companies to 20 stores, reopenings. So they're worth 10 million each, which is an amount of 200 million. In store remodeling, as you can see, it's the majority, because they have a lot of stores. They have 2,000 plus stores. In technology, they invest 731 million. In logistic infrastructure, 487. They distribute it in all of the stores. And the sustainability, it's around 487 million. It's basically all in billions. And the total capex is 4.34 billion, which represents 7.7 of total assets, which are 56.4 billion.
Okay, so now we talk about the income statement summary, as you can see here. Here's our final income statement projections for 2025 in this case. Target is expected to generate a total revenue of 115,191 million, and with a cost of goods sold of 83.1 million, approximately, leaving a gross profit of 32.1 million. After accounting for operating expenses and depreciation, operating income lands at 6.52 million, making it higher than the past year, for example. And following taxes of approximately 1.37 million, we project a net income of 5.16 million, which is a healthy profit for a retailer company of this scale target, right?
The balance sheet is pretty much the same. We have some key points. If you wanted to see more in detail, we have the Excel. But it's the total assets, as I said, it was 56.4 billion actually. And the current assets are 19.4 million. The liabilities are 41.9. And we follow the model that it's assets equals to liabilities plus equity. So if you add the equity plus the liabilities, it's a total of 56.4 million. So that represents it's a very healthy company.
So now we're gonna make we did some financial visualization so that you can see how it's distributed. For example, that CapEx target, making it the most part of store remodels. As Jorge was saying, Target has approximately 2,050 stores in all the US. So we are constantly remodeling all the stores, making it the experience for customers, applying technology, applying new things. So that's why the most percentage of their reinvestment goes to store remodels. The other part goes to technology, and then the other part is just for new store openings because we just open 20-25 stores per year, so it's just a 4.6% represented. And the other part that they distributed between logistics, infrastructure, and sustainability, that's representing 11.2%.
As we can see in the operating income, there's a little graph. In 2021, we can see that it was 6.5 million. Then it went up to almost 9 million. But then in the 2022 and 2023, they had a lot of decrease in the operating income. That was because of a lot of inflation and cost of inventory. That was during the Joe Biden's presidency. And in the 2024, they started going higher. And our projections in 2025 is almost keep the same as it was before.
So also to understand kind of how the assets of Target have been moving on, related to what my team and John just explained about the remodeling of the stores and the creation of the stores and the investment in technology, we see a clear growth in the tendency of how their assets are incrementing through the years. First we have 2021, and lastly we have the 2025 prognosticated to be even higher than the last year 2024.
Well, here we have another graph about representing the total revenue, that it's how they did by years. You can see 2021 it was around 79 million, 80 something. 2022 it increased, and 2023 it got down a little bit because of what Jorge was saying. And in 2024 it continued to be stable, but 2025 is projected to be higher. And to wrap up, our CapEx strategy supported that long-term growth, while revenue and cost ratio remain consistent. That financial model we built is fully integrated and balanced, simulating what a real-world team would deliver. Our assumptions were realistic and supported by data. And thank you for here is our team. Jorge, me, and Fernando. And thank you for being here. And if you have any questions, we're happy to answer you.
Yes. So you mentioned that your goal was to create a forecast, but what you presented was more like a budget. Can you explain what's the difference
Yes. So a budget was basically what we did in this case was representing the budget that would deliver the 2025, in this case, how our money was going to be invested, how our money was going to be distributed. And that's why it mostly is on our budget. So I don't know what it is.
So yeah, pretty much.
Okay, can you go to your sales assumptions? Explain me how did you get to the 150 million?
We multiplied the openings of new stores, and we average the average ticket of people, and then we multiply it times the visitors, and then we have 150 million.
Then we did that for the years 21, 22, 23, 24, so we can forecast the number 25, and also the the amount of stores, the stores percentual, we took it from the annual report. There was a small space when they spoke about how many stores they were planning to open later.
Yeah, historically, yearly they open 20 to 25 stores. So yeah, we multiply. I mean, it's a very consolidated company, so it has historical data that we can use to predict the 2025.
So you multiply 2,000 stores against 20,000 visits per store. So that means 42 million visits on an annual basis. From those, everybody buys
8%, it's an average ticket. Every 42.5 total visits, an average of how much they spend in the store is $62.
We have a lot of visitors that don't buy, and we have a lot of, it's a big storage, so there is a lot of inventory in storage.
So you wouldn't think that the products should impact the revenue?
I'm sorry, what do you mean by impact in the revenue? Because
You wouldn't think that products that target sales to the
Right.
customers impact the revenue?
of course,
Yes. So what are the main products? Why I don't see them here?
because given that we didn't, we took the information from a more general, from a general report, and we didn't thrive ourselves to look for that deep of what are like the best products. That's what you mean, right? What are the best products that target sales in which it gets more revenue?
So, yeah, it's an average about how much they spend in every visit, not just in a single product, but as you know, everything in Target is based on, it's a very, for example, cheap store, so they all have prices very similar, all things have prices very similar, so it's an average price that people spend on Target.
So tell me, what is the best line of product for Target?
And they have clothes, I think, it's, what do you call it? Electronics.
Domestics.
And all the technology, it's very varied.
Okay, go to your costs. What are the main costs that I can see there?
What are the main costs?
Okay, it's the 72% cost of goods sold for what's the detail? Labor.
We have a detail in the Excel.
No, I don't care the Excel, just tell me, you tell me.
I mean, like, we took it from year to year information. I wouldn't know what to say about, what they run their costs, but with the report, based on how retail stores function in worldwide market. That 72% are like the normal costs of any retailer will have. I don't know which they are, but it's like nothing above differently in the market.
In this case, it's very, in case of the expense categories for saying it like that, they have like, for example, general and administrative expenses, right? They also have like the depreciation expense.
But that's an expense. I'm asking about what else.
Cost and expense. They have the cost of revenue. They also bring the gross profit and the gross margin.
I want to know what's in the cost of revenue.
Yeah, I even took a detail because, like I already explained, I made it with the annual reports of 2021 to 2024, which are just the revenue and then the cost of revenue to get those numbers and those ratios.
It's approximately, for example, the cost of revenue, it goes up to 84 million, representing 72.8%.
Okay, go to the right, go to your income statement. In income statement, always, if you're doing a proper budget, I don't know if that 115,000 million is correct. How should I know if that's correct? Or it's following a trend?
It's following a trend, but it's also based on
How could I know if I'm watching that?
it can be known because of our operating income, the cost of goods sold, the gross profit, and based on that, it's projected to have the 150 million. It's a billion in this case.
Okay, always, if you're showing actual data, that's your budget, put the past, bring the prior years.
Yes.
So I can look for at least it makes sense that amount. And go to right. Answers like to see more detail, watch the Excel now. That's not. I wouldn't accept any budget like that. Go to right. Again. Just be careful with the when you put the chart. I don't know what I'm watching.
The number. I mean, yeah. Sorry.
What I'm watching in there.
Total assets.
What?
Total assets.
Okay. Total assets, x-axis, and put some little format on the numbers, okay?
Yes.
To the right. Oh, here you do it. Total revenue amount here. In the prior one, you also do it. Okay? So thank you very much, guys. Adelante. Go ahead.
Okay, so today we're gonna present about Amazon. So it's our capstone project for managerial accounting concept. So it's presented by me, Jimena Rivera, and my partner, Mariana. So for a quick overview of what we are going to show you, first we're going to see a little part about Amazon, the company background, business segments, the main source of income. Then we're going to talk about the part of financials, which are the sales assumptions, the cost assumptions, expected assumptions, current assets, short-term liabilities, the CapEx, and the funding needs that we're going to use for our project. Okay, so quickly, for giving context about Amazon. Amazon is a global company that was founded by Jeff Bezos in 1994. First, it was an online bookstore, but today it is the global leader in e-commerce, cloud computing, logistics, digital streaming, and artificial intelligence. It is divided in three main segments, which are North America, International, and the web platform that is AWS. Amazon is known for its customer-centric model, mass product solution, and advanced use of technology and data. Also is a good example for a company that managed to use their costs and relate on real-time data for budgeting prices and operational decisions. Okay, so the business segments that we have for Amazon are first the online stores, that is the e-commerce, where Amazon sells directly to their customers. They also have a third-party marketplace, which is an independent place for independent sellers to offer products to their clients. Physical retail stores, they also have subscription services like Amazon Prime, where they get revenue from subscription-based products. And finally, advertising services that involves sales of advertising services to sellers, vendors, publishers, and others, allowing them to promote their products via Amazon. The main sources of revenue, which are related to the ones that I just said. The biggest one are obviously the online stores, since Amazon is an e-commerce. Then we have the Amazon Web Services, the third-party seller services, and the advertising services, which are the ones that give Amazon the most revenue. Okay, so for the sales assumptions, the total revenue that Amazon had in 2024 was for more than 600 billion. So to make an assumption in base of that, we project the growth using this historical data, and we multiply it. So for 2025, they will be making a total revenue of 700 billion, and we basically round it. From that, we have a cost revenue of 380 billion and a gross profit of 220 billion. This total revenue can be expanded in different sources. We have the online stores, that is a 42%, the third-party services 23%, Amazon Web Services 16%, subscription 7%, advertising 11%, and other 1%, giving us a 100%. This can be justified since historically it's known from that the online stores means from 40 to 45%. That's why we put 42%. We also know that the commissions, the shipping fees, and marketplace use means 23%. The services, for example, in historical data is around 8%. That's why we put 7%. And well, yeah, that's our sales assumption. Then we have our cost assumptions. The average cost revenue from Amazon is about 50%. So we rounded, like we count from 2021 to 2024, and it gives us 40%. So we multiply for that, and it gives us 380 billion. Okay, so the expand version of this cost revenue, we have categories like the cost of goods sold, that is the 45%. We have technology and infrastructure, that is 10%, marketing and advertising, 7%, general and administrative 6%, customer service 5%. So this can be justified as Amazon is based in logistics, warehousing, and historically, the 40 to 48% is the total revenue. That's why it's the dominant one. And for example, for advertising, the paid of ads for customers is usually the 6 to 8%. That's why we put 7%. And we basically make like an average of to get the cost assumption. And finally, we have the expenses, the operating expenses. We have this 265 billion, which expand in selling, general, and administrative, other selling and marketing, and other operating expenses. We have selling, general, administrative, 22%, which includes corporate, overhead, marketing, and administration. General and administrative, which is the 5%, which is the part of the legal, finance, the human resources, and office costs. Selling and marketing, 17%, which is brand building, corporate campaigns, and fixed marketing. And other operating expenses, which include support, intelligence, like fixed costs, and other expenses. These all assumptions were based on the historical data that we have and the average of the past 5 years.
Okay, so here we have the uranium sets. As you can see, we analyzed from 2021 to 2024, and you can see in 2022 there was a big drop. It decreased almost 20 billion. So, but they recovered and then they went up again in 2023 to 172 billion, 2024 to 190 billion, and in 2025 it's expected to be around 201 billion. Analyzing this, we can say that there's a strong liquidity. Even they have a big decrease in 2022 because this is indicating that the increased liquidity and financial flexibility. Also, there is rise in receivables over 23 billion since 2021, which reflects growing sales, but also the need of tighter credit management. The growing current assets increased by nearly 45 billion since 2021, supporting Amazon's capacity to meet short-term obligations and fund operations without raising debt. This reserve has modestly increased to 2 billion in 2024, showing greater risk management on receivables. Okay, so for the short-term liabilities, there's a growth that suggests increasing operational scale. For example, payables, the main account payable, follow as trend. It started in 2021 in 78.66 billion, and in 2024 it goes up to 179.43 billion, and the prediction for 2025 is 193.6 billion. The aggregate expenses also grew around 66 billion, possibly linked to growing payroll, utilities, or interest obligations. The deferred revenue increased moderately around 18 billion. This reflects higher advance payments from customers. For example, the gas subscription or the website. Yes. So this is our CapEx. As you can see, we analyze different areas they use it. For example, the website infrastructure, fulfillment and logistics, industrial landscape, and video stores, but it's almost not visible because it's a very low number. Here the blue represents 2023, yellow is 2024, and the green one is the projection for 2025. As you can see, Amazon is going to invest more in these areas because they see a big potential on having a big revenue. They're thinking to invest in 2025 around 100 billion, more than AI usually, because in 2024 they finished around 84 billion. So they are willing to expand this to have more. So for the funding needs, so Amazon funding needs for 2025 are estimated at 120 billion. This is driving major investments in logistics, AI, and global expansion, while reinforcing sustainability and cloud leadership. For example, for sustainability, they are willing to invest around 5 billion in different areas like renewable energy, electric delivery, and carbon footprint reduction. In technology and infrastructure, there are around 60 billion. For example, the logistics for expansion, data centers, global last mile delivery. Also, there's the fulfillment network automation, around 25 billion. And this is robotics in warehouse, run autonomous delivery, and warehouse people in North America. Also, in research and development, it's around 15 billion for AI-powered recommendations. Like I said before, Amazon is looking to invest a lot in AI because it's growing really fast, so they see a lot of potential in this. They also in digital service expansion about 10 billion for Prime Video, streaming content investments, Alexa consumer devices, or international digital commerce platforms. For the working capital and debt repayment, it's around 10 billion to support the short-term liquidity and smooth long-term debt repayments, and to strengthen cash flexibility across business units. For strategic acquisitions and innovation, it's around 10 billion, like AI, robotics, and logistics firms, investing in next-gen e-commerce tools, and increasing customer experience and personalization.
Okay, so for the conclusions, we have that Amazon in 2025 have a projection of height and continued dominance and growth with a total revenue of 700 billion, keeping a cost of revenue around the 50% of cost of the total income. Also, Amazon balance sheet shows current assets of 190 billion and current liabilities of 179, reflecting a stable liquidity and operational strength. And for our capex, Amazon for 2025 is projected at more than 100 billion, 105, driven primarily by AWS expansion, fulfillment network growth, and AI infrastructure investments. And our sources. Thank you so much, and if you have any questions.
So you broke down sales. Go to your sales assumption, please. You applied historical growth for each segment. Great job. But can you explain why you didn't choose any other projection method rather than adjusting the recent trends or the macroeconomic conditions that the US have right now?
Okay. We did it because I see it like it's a constant growth, like 2025, I think it's like, oh, well, comparing total revenue to cost of revenue, they all have like a similar growth. They all are in the 50%. So seeing that the trend is being very stable for the last five years, I can see that for the next year, it will continue to follow that pattern. And we don't see any major events that can move like very much different from that, like another very different number.
Did you validate your growth rates with any external forecast or benchmarks for Amazon business units?
Like comparing them with other companies, you mean?
What's your source
Of what?
of those percentages?
Of those percentages?
Not the result, the percentage.
Yeah, the estimated. Well, it's from the report annual. They like give us. Well, if this report is not showing complete, that for example for Amazon, for e-commerce historically, like from 5 years, is around 40 to 45%. So in an average, we choose 42%.
Okay, very good. I like how you show the results in a different table. Forward from the assumptions, we'll go to the balance sheet. Why did you change the format there?
Here.
Yes. And I didn't see because of the airtime thing.
Yeah, and I think it's
But
like
that column is for 25, 25, right? Because I saw it's 24. Exactly. Why am I watching 24 and where's the 25? I want to see the budget, right? The chart's okay, but I want to see consistency regarding the format. Okay? Those are things that you have to start managing because at the end, when you go out of the university, that matters. Okay? You will present this to an executive, right? Okay. Just to add something of value for you, you had a lot of text in the first slide. The thing is that I will start reading and I won't pay attention to you. So if this presentation were sent to the executives without your voiceover, do you think they would understand the key takeaways?
maybe not the complete presentation.
What would you think you would done better to improve?
So, for example, in this part of assets and short-term liabilities, like justifications, maybe, like regarding the numbers, because we can see like a table and a graph and numbers, but maybe I don't know how to compare.
Because I didn't ask you about the cost and expense, I understood perfectly. Okay. And I didn't ask you anything about the capex was great, and the funding needs. But I think you have a lot of things to do here to improve, okay? So thank you for. Chicos, ¿cuántos equipos faltan? 4, ¿no? 20 minutos, los cortos 20 minutos, ¿va? Por favor. Sí, aprox 20-25 minutos, ¿vale? Porque perdimos unos minutos, pero para que no se. Si los corto, no se vayan. De cero. No. Voy a aprovechar en lo que se instalan, voy rápido al baño, chicos.
¿Hacemos una ruleta o qué?
Sí, ya,
Sí, no tenemos recuerdo. ¿Quién se anima?
Ah, ¿no quiere nadie? Yo elijo. A ver, los que más me preguntaron. L'Oreal. ¿Quieres verte? ¿Quieres verte? Dale.
Sí, yo sé.
So, good afternoon, everyone. Our team is made up by me, Jose Ángel, Ariana Pino, Pamela Diego, and Santiago Ricardes, and we are going to present our capstone project regarding L'Oreal.
So, the company's background. L'Oreal was founded in 1909 in Paris by Eugene Schuller, a French chemist who developed a groundbreaking hair dye formula. Today, its headquarters are in Clichy, France, and it operates in more than 150 countries. Scope and reach. L'Oreal doesn't just sell in a few countries, it's a truly global company. Its strongest markets are in Europe and North America, but it's growing fast in Asia Pacific, especially in China and India. It reaches billions of people through a wide mix of brands, from drugstore products to high-end luxury and even dermatological care. L'Oreal holds around 12 to 14% of the global beauty and personal care market, making it the largest cosmetics company in the world. Its mission states to offer all women and men worldwide the best of cosmetics innovation in terms of quality, efficacy, and safety. Its vision states to be a global leader in beauty, empowering every individual to express their unique personality. So, business model. L'Oreal's business model is built around strong product innovation, digital channels, and strategic partnerships. They sell through stores, salons, and e-commerce platforms. They focus heavily on customer experience using technology like virtual try-ons and AI-powered recommendations. Their main revenues come from product sales in skincare, hair care, makeup, and fragrances. So what makes L'Oreal different? What sets L'Oreal apart in its scales and diversity? They have over 35 brands covering every segment, mass market to luxury. They invest a lot on research and development and tech, things like personalized skincare and virtual beauty tools. They're also leaders in sustainability and inclusion with products made for all skin tones and hair types. Plus, they grow smartly through acquisitions and bringing more innovation and reach. And competitors are Estée Lauder, Unilever, Johnson & Johnson, and P and
Now we're gonna go a little bit through the L'Oreal's financials. First, we're gonna see the balance sheet forecast. L'Oreal total assets grew over 40% and equity by 51%, reflecting strong financials. Despite the expanding operations, net debt remained low. Their good financial management reduced reliance on borrowing. Increased inventory and PPE, the property, plant, and equipment, suggest that L'Oreal is scaling production and infrastructure to meet global demand. We can see the trend. The total assets went from 43 billion in 2021 to 60.8 billion in 2025, representing a 41% increase. Our assumption is that probably is sustained by reinvestment of profits, business growth, and possible acquisitions. Next. Now we're gonna go through the profit and loss forecast. We can see that there is a consistent and steady growth year over year. Also, we can see a strong market expansion and product demand. The value increased by 49%. In conclusion, the forecast indicates a positive performance, reflecting strong sales and expansion in the market. The company stayed healthy despite rising costs, indicating strong operational efficiency. Increased marketing investment suggests a focus on brand strength and global visibility.
So now, with the different information we got from the annual report, the income statement and the balance sheet, we carried out different types of analysis in order to understand different aspects of the financial structure of the company, such as the profitability, the liquidity, the solvency, and the efficiency of L'Oreal. And first, we have the profitability. As you can see, margins are strong and improving, and this is specifically in the part of the gross profit. As you can see, it has a 74%, which is really, really high, even compared to other competitors. And this is because L'Oreal is a company that focuses on like a premium segment. So they are able to charge or price their products in high margins and get more revenue from it. But also we can see that they have a really low, not really low, because in other brands in the industry it's similar, but for example their operating profit drops to a 90% and the net profit drops to a 14%. This is primarily because L'Oreal invests a lot in R&D advertisements, because in premium brands, it's really expensive to carry out advertisements. They have different sectors that are in over 150 countries. So these costs lower that significantly. And yeah, as we can see, L'Oreal is highly profitable, but it should have a more of an attention on different costs that might lower down the net profit. And now moving to the liquidity. This is one of the strongest aspects of L'Oreal. They have a 112.5% in the current ratio, which is really good since they can cover all current liabilities, but they don't have many assets that are idle or generating extra costs. And as we can see with the quick ratio and acid test, L'Oreal has a strong inventory reliance with an 80.92%, which is very common in CPG companies and especially in companies that are premium, since they charge more, so the cycles are not as fast as other companies that charge less for the products. And this means that L'Oreal has a intensive working capital model due to, as I mentioned before, due to premium strategies, their global operations and presence, and the overall dynamics of the beauty industry. And now moving on to the solvency, we can see that L'Oreal has a conservative capital structure. This can be seen since they have a 25.64% in their debt to equity ratio, which means they fund their operations or investments or activities primarily through equity. And the implications of it is that this makes L'Oreal a more financially stable company, but it also lower returns for the company. And finally, for the efficiency, we can see that in L'Oreal's case, customers pay quickly. They have a 35.44% receivables turnover ratio, which translates to 10 days. But as well, we can see that they have a long inventory turnover, which is 2.46 or 148 days. This means they have a low working capital, which shows kind of inefficiency, but also you can see that overall in the full company financials that it is because they rely on the inventory. And now, in order to analyze better what that implicates for the company, we can look at it with the different competitors, and we are comparing it to P&G, Unilever, and Estée Lauder. First, it is important to note that L'Oreal has a high margin business similar to Estée Lauder, and in relationship to other companies like P&G and Unilever. And this is because many of the segment or target market they have, since Estée Lauder and L'Oreal focus primarily on premium segments, and P&G and Unilever have lower margins. And another strength of L'Oreal is that they have a strong liquidity, similar to Estée Lauder, indicating that they can pay for their short-term financial obligations. And this is a different from P&G and Unilever, since they have a more aggressive approach, and L'Oreal a more conservative one. And also, when we compare the companies, we can see that L'Oreal is the only company among this four that has a lower debt ratio, which means they have more stability but lower returns, as they have not such an aggressive approach to their funding needs. And at the end, in the part of efficiency, we can see that L'Oreal is staying a little bit behind in relationship to other companies due to their focus on premium strategies. And I wanted to note two things. First one is the P&G, which has a different approach to L'Oreal. They have a more aggressive approach to their funding, since they value more or put more focus on debt, and they also have a really good financial cycle, since they are able to convert their inventory, their sales, into cash, meaning they can invest more in other projects in R&D. Meanwhile, that is not the case for L'Oreal. And another company I wanted to highlight is Estée Lauder, which is very similar to L'Oreal, but they have a different approach to funding, which is they rely heavily on debt. And we can see that that is what it's making them have more financial trouble, since their net profit is really low, and as well, like, they are struggling, since they are going through a hard time. They're struggling to repay.
Okay, now so for the WACC and the IRR, we got a percentage of 6% on the WACC, which basically means that for every euro that they spend, they get a return of 6 cents. So it's actually a very good WACC for them. They get a return of 6%. And then for the IRR, we got a lower one, which was 2%, about 2%. And it basically, it appears to be like they don't have enough return, but in reality, it's because it's only calculated for the first 5 years. When you calculate it for a longer period of time, you get a higher return, because the investments that they make are actually long-term investments. So in the long term is that they get back the return of what they put in. And then for the stock fair value, we got that the current market price is 440 euros, and that the fair value estimate is 380 euros. So it basically shows that the value of the stock is kind of overpriced at the moment. So yeah, and for a recommendation based on this would be to just wait and see. So not invest right now, and look at the long-term investments that they have, not only 5 years, and wait for the value of the stock to drop a little and to be closer to the reality, and then see how it goes from there. And thank you.
I would go to the questions afterwards, but go to the presentation, guys. It was wonderful, good metrics.
What part?
I noticed that you did learn what you needed to learn, but present it, please. Guys, the charts. If it's properly formatted in Excel, maybe you can save these ones. Although the previous ones. Okay, I can see even the Excel cells. And can you tell me what are the numbers? What numbers are we watching in the chart?
This is the. Well, in which one? Oh, the chart.
And guys, you don't need to paste everything. If you explain it properly, you can just put revenue, cost, and the margins, and that's it.
We lowered it because there were like
Okay, you can put a table in Canva or in PowerPoint, I don't care. And it will be 10 things to copy and paste, and you can put a professional chart in there.
Better to see less than what not see.
And that's like the summarized part of the summary.
No. You can summarize it way more.
Which one?
There are even things that I don't want to see there, and that I didn't teach you at all. Like, what's basic EPS? Why did you put it?
We didn't know
It was just there.
how many.
And what is this chart for?
We didn't know how many. This is the kind of the financial.
I know. But guys, it's like you make a great presentation and you do this type of things that looks very unprofessional. So go to the right, please. Good explanation of the ratios, perfectly well understood. In here, what do you prefer, P&G or L'Oreal? Because I didn't understood that part.
I would say PNG in this time because they have more like returns due to their approaches, and like L'Oreal is more like it has great investors' confidence, but it's like since it's really stable, it doesn't offer like
And I wouldn't accept your conclusion regarding Estée Lauder. I had a lot of questions in that part.
Okay, like which
How do you know it's because of the debt approach?
nobody makes it like if a company is struggling and they have more, I think, equity, more ratio in equity, they don't have the pressure.
What's cheaper, equity or?
At long term, it's equity, but in
Cheaper?
cheaper. No. Long term, equity is more expensive. But in the long term, like the problem with debts is that it presents more of a pressure to companies to repay if the debt is approaching. Meanwhile, equity, if they are going through a hard time, the investors are the ones that take a little bit more of the hit in that
The
part.
thing is that you don't over debt. That's why you analyze the solvency. You don't want to over debt, but at the end, if you just need working capital, you can calculate that working capital and ask for that debt.
Okay. But like
I don't know if because on the ratios that you're showing me, the operating profit is 10 points, almost 10 points lower than L'Oreal, Estée Lauder. So, and the debt, it's not because of debt, it's because of the expenses.
okay. But like even if they have a like it's a question.
No, so always conclude based on data, okay? What is the most relevant ratio that for you to choose L'Oreal over the other ones? What would you show me you wanted me to invest in your company?
Like, I would show the liquidity, since it's the strongest like aspect they have, and like solvency and liquidity is like an important aspect for investors. Also, they need to know that the company is able to repay obligations.
Well, 120 days for inventory.
But that is the liquidity, but like I won't show the efficiency.
Yes, because they have more days.
Ariadna, you mentioned L'Oreal earns 6% return for per euro invested. Can you walk us through that assumption behind your WACC calculation?
So
So the 6% rate, it's basically the weight of the debt times the cost of the debt plus the weight of the equity times the cost of the equity, and it gave us a 6% return. So it just means that overall, why are you looking at me there?
I have to look at it.
It just means that overall, like on the investment, any investments that they make, 6% is what they get, and and it's what they use to pay for that investment. So, for example, if they give them, because it's from the lenders and the investors, if they give them 100,000 pesos or dollars or whatever, they get they have to incur the cost of 6%.
Perfect, wonderful, because it seems like you said that for every investment they get in return 6%, which is
No,
not
they
a
pay
proportion,
six cents for every euro.
for financing costs. What is your financing cost? Okay, obviously you need to earn more than the cost, obviously, because otherwise you won't be paying the finances, the creditors. Okay, very good. So just give me a conclusion of the stock value. How did you get to the stock value and your last conclusion?
Oh, so our conclusion about investing in the stock. So for the IRR that we calculated for the 5 years, it gave us a 2% return on investments, and it seems kind of low. But in reality, when we started searching more about it, because we were actually shocked, because it's way lower than the WACC, and it showed us that over the long term is that they make more investments. So our conclusion is just that wait till the cost of the stock market, of the stock in the market lowers to the price that that is in the market actually, that is right now. And then what was I saying?
So you think that the fair value of the stock is 380?
And
we
so
will have to wait for the
it to lower a
market
little
to
bit,
match.
and then you will also have to take into consideration that in the short term, you're not gonna make as much of an investment as you do in the long term. So it's wait and see, and then do it not for a few years, but for a longer period of time. And then just sell it if you have an emergency or something like that, but it's something that you're not gonna see the returns right away.
Very good, guys.
Estudiar,
Ay, me matan esas tablas, ¿eh?
Que me matan.
Sí, adelante.
Hi, everyone. Good morning. Today we'll be presenting our capstone project for financial statements on Amazon. It's presented by our team. I'm Isabella. Where our team go? Lizano, Micaela, Mariana, and Camila. So here's a quick overview about what we will be talking about. We have our About Amazon section, which basically just tells you the company background, business model, key differentiators, competitors, and then all of the Amazon financials, which we'll get into later, and our conclusion. So first we have About Amazon. I believe most people know what Amazon is. And if you don't know what Amazon is, you're kind of weird. But I'll tell you what it is. It is one of the most influential and one of the most diverse technology companies in the market. It first was founded by Jeff Bezos on July 5th, 1994 in Bellevue, Washington. Currently, its headquarters is in Seattle, Washington, and Arlington, Virginia, which is located in the United States. And its current CEO is Andy Jassy. So Amazon first began as an online bookstore, but it has been innovated into much more than that, as they have dived into electronics, clothing, home goods, groceries, and virtually they're selling every category of retail, as they have transformed themselves into the largest online retailer in the world. So let me share with you their mission statement, which is to be Earth's most customer-centric company, where customers can find and discover anything they might want to buy online, and endeavors to offer its customers the lowest prices possible. And their vision statement is to be Earth's best employer and Earth's safest place to work, as well as to build a place where people can come to find and discover anything they may want to buy online. Next, we have their global presence and scope. Amazon has a vast global network, as their e-commerce platform operates in more than 20 countries, which include the United States, Canada, UK, Germany, Japan, India, Australia, Mexico, UAE, and Brazil. Their workforce has more than 1.5 million employees. And for their logistics network, they have more than 175 fulfillment centers, more than 40 cargo planes, and they even have their own shipping fleet. AWS, which is Amazon's web services, is used by companies and governments in over 180 countries.
Okay, now we have Amazon business model that starts with customer segments, which includes individual consumers that are the shoppers, third-party sellers, advertisers, prime members. For value propositions, we have the fast and reliable delivery, wide product section, and competitive prices, scalable cloud computing that is from Amazon Web and Services. For channels, we have the global e-commerce platform that includes Amazon.com and the mobile app. We have the physical retail that is Amazon Go, Whole Foods, Amazon Fresh, and some smart devices as it is Alexa, Kindle, Fire TV, and Echo. For customer relationships, we have personalized recommendations, 24/7 customer support, self-service, and auto-monetization. Also, some loyalty programs with Prime. For revenue streams, we have direct product sales, also third-party seller fees, as it is commissions, FBI fees, that is the fulfillment by Amazon, Amazon Prime memberships, and AWS subscription and usage fees. For key resources, we have the global logistics infrastructure, data centers in cloud technology, also software and algorithms based on AI and machine learning. Also, engineers, managers, fulfillment workers, and a brand in customer base. For key partnerships, we have third-party sellers and suppliers, the content providers that are movies, books, games, and key activities. We have managing e-commerce operations, and logistics and delivery management. For cost structure, we have fulfillment and shipping operations, technology development that includes R&D servers and AI, marketing and customer acquisition, and employee salaries and benefits.
Okay, now that we know about a little bit of Amazon, I'm going to talk about key differentiators. Firstly, we have customer-centric culture, which means that Amazon is currently obsessed with customer satisfaction. This means that the most important thing is that the customer is happy. So they focus on one-click purchases to make it more effective, easy returns, and in most cases we have free shipping. And then we also have personalized recommendations, so you keep coming back to the app and buy even more. And then another important differentiator is that we have massive scale and selection. So you have millions of products of the same category, and you have millions of options that you can select. And they also have a vast seller network through its marketplace model, and they also have competitive prices within the scale and automation. Now we're going to talk about the main competitors. First, we have Mercado Libre, which is very strong in Latin America, #1 e-commerce, especially in Brazil, Chile, and Argentina. And it's important because they offer its own payment platform, which is Mercado Pago, and compete directly with Amazon Logistics and Marketplace. Then we have Alibaba, which is strong in Asia, especially in China, in global business. And they serve as international consumers, low-cost Chinese goods. And finally, we have eBay, basically because they are strong in reselling auctions and collectibles. And they also have a strong, loyal buyer community. So here we have the e-commerce market share. It's, as you can see, Amazon makes up to 41% of the e-commerce market share, making it the most. Then we have Mercado Libre, as they are only strong in Latin America, it's only 3%, eBay 6%, and Alibaba for most of Asia is 38%, and then with the others occupy the 72%.
Okay, so now we're going to begin with the Amazon financials. We have Amazon ratings. Okay, so we separate in four categories: profitability, which shows how the company ability to turn their sales, assets, and equity into profit. We can see that they have a high gross operating and net profit, which means that they are effective at managing the cost of operations like sourcing or manufacturing. Also, the return of equity is great, is above the 50%, which is the benchmark for this type of companies. So for every dollar invested by shareholders, Amazon returns almost 21 cents, which is a high percentage. We have the return of assets at 9.5%, which also shows an efficient use for the assets. For the liquidity that measures the company ability to pay their short-term debt, we have the current ratio with above 106, which shows that they can meet their short-term obligations. However, for the quick ratio at the asset test is below the 100%, which usually means that the company cannot meet the short-term obligations if it's not for the inventory. But for Amazon, that is a retail company, this is not an alarming percentage because they have a fast inventory turnover, which means that their inventory is never stocked, it's very liquid and can convert to cash very quickly. So it's okay. Then we have the leverage, which shows us how the company use debt and how much they rely on debt to finance their operations. We have a little debt to finance the operation percentage, which is 20%. They don't rely too much on debt. Also, half of the assets are financed by shareholders with a 45%. Debt to asset, 20.9%. And interest coverage, Amazon can cover its interest expenses 30 times over. Then for the efficiency index, the finance cycle is negative 32 days, which means that Amazon doesn't need to get, Amazon first regulates the accounts receivable and first sells the inventory, and then they pay to their suppliers because they have a very quickly inventory turnover. So this is very good and not very common for most of companies.
Okay, next we have Amazon's financials, peer analysis. So we'll begin with the liquidity. So Amazon's current ratio is 106.37. Although it is the lowest among its peers, it is still strong and consistent. What this means is basically Amazon is just more efficient with their short-term cash than their competitors. As for their quick ratio, which is at 87.31, this shows that they have good liquid assets. It means that their cash is near and accessible. It is better than eBay and Alibaba's, but it is below Mercado Libre at 119.53. Next, we have their leverage. Their debt ratio is 20.95%, and Amazon uses a moderate debt financing, which is less than eBay's at 40.6%, but it is more than Alibaba's at 11.65%. And their debt to equity is 20.95%, which just confirms that Amazon has a balanced use of their debt financials. Next, for their profitability, Amazon's gross margin is at 48.85%, which is higher than Alibaba's, which stands at 37.77%. And Mercado Libre's, which stands at 46.09%, but it is lower than eBay's. eBay's is the highest at 75.23%. Next, for their EBITDA margin, Amazon's is at 15.47%. It is the lowest among its peers, but this just shows us that their competitors are not as focused on the future as Amazon is. Amazon runs a low profit, high volume model, which means that they have low margins, but a high market share as they focus on volume and growth. Next, we have their returns. For their ROE, Amazon ranks third with 20.72% among its peers, as Mercado Libre has 43.92% and eBay has 38.92%. It still generates a consistent and a solid value for their shareholders. For their ROA, which is at 9.48%, Amazon uses their assets efficiently as it surpasses Alibaba and Mercado Libre's. For their coverage, their interest coverage is at 30.2. Amazon can pay its interest 30 times over, which is a good sign, as it is not as high as Alibaba's at 931.6, but it is much better than Mercado Libre's, which is in negative. Since Mercado Libre's is a negative, it is a red flag, which is a financial risk for its main market, which is Latin America. But Amazon's, it is still lower than eBay's, which is 128.31, but it is stronger than eBay's in terms of real financial health.
Okay, so for the stock fair value, I checked yesterday the data to keep it like fresh. So if we take into account the peer rate that I saw yesterday, the fair value will be around 210.71. But I wanted to keep it like more real and stable, so you put it around 30 to have like an
another point of view, so it will be around 183.9. So this suggests that yesterday their current price was 210.1. So we can say that it's like a little bit overvaluation, around 14.6%. But I checked, and in 1 year, their estimate is around 237.02. So it will be up 12.5%. And so Amazon is a strong long-term investment, while its current is 210. This is like about its conservative fair value. Analysts predict that it will rise to 237 as I said before. So it's a consistent earning and dominant market position, ongoing innovation. So it shows a solid growth potential. So these estimates help to protect investors from overpaying price tag. So I recommend to make the investment because as we can see it will go up in here. So yeah.
Okay, now let's take a look to the Amazon's IRR, internal rate of return. This rate shows how much it's earned each year from the money you invest. First, we need the market price, which I took an average of 52-week range, which it was provided by Finance from 152 to 242. So the average is 197. We also need the CAGR, which is a way to measure how an investment or business has run over a specific period of time. And because we have no forward dividend for 5 years, which is 12.2. This gives us an IRR of 10.1%. Okay, so when we compare it to the web that is going to be next explained by my partner, we can see, well, I can tell you right now that the IRR is above the web, which means that Amazon is generating returns higher than its total cost of capital, which means that they are using efficiently their capital, and also it creates a positive value for both shareholders and the creditors. So a described stock appears to be a financial solid investment.
Okay, now to see what Jimena was talking about, we can see here our weighted average cost of capital, where the cost of debt shows that Amazon benefits from a very low cost of debt. We calculated, and the cost of debt after the tax is 1.59%, which reflects that Amazon has a strong credit rating and a low risk to lenders. Sorry. This is very favorable and shows cheap access to debt finance. For the cost of equity, we use the risk-free rate from the US Treasury bonds and the beta. Also, for the market return, we use the 10.4% that gives for annual return from S&P 500, where we can see that investors require a return of 12.35% to compensate for the risk of investing in Amazon. So since Amazon's beta is about 1, it is more volatile than the market, which increases the expected return required by the shareholders. For the capital structure, we can see that it is primarily financed with equity, because debt is only about the 31.4%, and the total equity is for 68.60. So this indicates a strong and conservative financial position, reducing financial risk and influencing the WACC to lean more toward the cost of equity. So the WACC calculation gives gives us 8.97. That means that the company must earn at least this percentage of return on its investments to create value and meet the expectations of both debt holders and equity investors. And this is a healthy percentage that has a competitive rate for a global tech company as it is Amazon.
Okay, so now we have the 2025 balance sheet forecast. We can see that it goes from 2025 all the way to 2021. And we can see an increase in assets. I'm going to explain it later, but we can see first impressions increase in assets, but as well as an increase in liabilities. So, as I said, we have an increase in assets based on the continuing investment and revenue growth that goes year by year. Assets grew 20% in 2024. So this means there will be a base case increase of approximately 13% in 2025. As it is not an aggressive increase, it's just only a base case which starts up to 13%. Then, as I said, we also have a slightly increase in liabilities, up to 9%, especially from debt and account payable. Then we have liabilities also growing slowly, so we project a 9% increase. And then we also have equity growing by 42% in 2025, in 2024, sorry, and we forecast a slightly slower increase, 30% as growth normalizes in 2025.
Okay, so for the profit and loss, here is the graph that shows 2021 was around 469 billion, and in 2025 is predicted to be 637.9 million, which shows a growth of 36% from 2021 to 2025. Also in the gross profit, there's predicted a growth from 137.5 billion to 319.
Conclusions, please.
So there's a healthy margin improvement of 62%.
I have to cut these conclusions.
Conclusions, well, basically, Amazon is a global leader. They generate their income from various sources. They don't just do it by selling their own products. And they are financially strong as their gross margin is 48.9%, leading to good profits. It uses little debt and can pay its bills easily due to its 30.2% interest coverage. It is a good investment as it has an ROE of 20.7% to its investors. Amazon is efficient and well managed. And Amazon is a smart investment as their IRR, 10.1%, is higher than their cost of WACC, which is 8.97%. It creates value for its shareholders. Although its stocks are pricey, they're good long-term potential. So choose quality over quantity as Amazon is a good investment.
Would you recommend us to buy it?
Yes.
But it's overpriced.
But they have a vision for the future. They're investing into the
Go to your fair value, which I didn't taught you that methodology, but it's okay for me. What's the conclusion about this? It's the current value is $210 and the fair value is 183. Why should I buy it? Why?
Because it is projected to grow to 237 in 1 year. So it's so based on the analysis that there is a prediction of growth for 1 year and for so also I see that for 5 years there was like the whole of it. I remember. Well,
You could just look at the return on equity, right?
thing with that methodology is that you're not considering the growth the next years. That's why it's your fair value is way low. Okay? That's why I told you another methodology, not that one. Okay? You can compare them and you can use them whatever it benefits you, but in that case, you maybe are subvaluating your assets. Okay. Why am I missing one company? There are 5 of you team members, and I only saw 4 companies. Go to your case analysis.
Three other companies. Since we started to do the project,
That it was 3 only companies.
What happened?
But you told us it was only 3 other companies.
Yeah.
Like other than Amazon, it was only 3.
Guys, what did I tell you about the final capstone? How many companies?
one for each. You checked on us when we were doing like the first
Who
one.
were-
I think it was because we are the only group of 5.
Who missed their company? Who of you?
We did like
So,
personality.
okay,
We both with
Susana and I
Amazon.
will go with like Amazon, because it was like the main focus, and then each one of them.
Okay. I think there are some miscalculations in the risk analysis. I will check your Excel. Just wonderful. The format was great. It has been the greatest of them all. But just to, if you're doing the things great on the format, you just need to take care of these aspects. No? Like each row have a different length, size. Just watch the format and try to align to the center and make them bigger because I can't read. Okay. Go to the previous one. Wonderful. That is how I should look on the rest of the numbers. Okay. Next. Oh, that's next. Again. In here, the IRR is above the WACC by 1.13. Okay. I understood. Another thing, I thought that the WACC was 1.13, but the WACC is
8.9.
So how can Amazon lower down the WACC? Go to the right. Next. How can Amazon lower the WACC? Is 8.97 good or bad?
Well, for a company like Amazon that has like that constant cash flow movements, I think it's depending on the ARR because they're like similar values.
How can we lower down the WACC?
By yes, because of how much they're spending.
But how can we, what should you suggest to Amazon so they can lower the WACC? What would happen if you lower the WACC? What would happen to Amazon value?
it will be.
Why it's larger than L'Oreal? How much was for L'Oreal the WACC? 6. Which is riskier, Amazon or L'Oreal? Amazon is riskier than L'Oreal? Because of the WACC that is lower? No, just tell me, in what company or what company you think it's riskier to invest in L'Oreal or in Amazon? In L'Oreal, why?
Because, well, first, I think their WACC was greater than their banker car. So that means you are not getting any return, you're just like paying.
Very good. Very good. Which one is larger? Amazon or L'Oreal? Way more large. More capitalization, more investor. Which one is riskier? L'Oreal is riskier, and they have a lower WACC. What is happening to your WACC?
Because we don't have we don't have the current short-term debt is in 0. So we have to.
That's the answer. They have to balance out their debt. You can repurchase company stock and the value of your company will increase. Okay. Well, thank you very much. Venga.
Hello. Yeah,
Good afternoon. We're gonna present our Capstone project, which is Birkenstock is our company, and we're Diana, Megan, and Denisa.
So Birkenstock was founded in 1774 in Germany. It began as a family shoemaking business focused on foot health. In 1896, Conrad Birkenstock introduced the orthopedic insoles, and in 1963, the iconic Madrid sandals were launched, which prioritize comfort. The brand entered the US in 1966 and gained fashion popularity by the 1980s.
So Birkenstock went public on October 11, 2023 on the New York Stock Exchange. This happened because they wanted to raise their capital so they can have a global expansion. The IPO aimed to support growing demand, strengthen its market position, and fuel innovation. So Birkenstock's mission is to provide sustainable, high-quality footwear promoting foot health. And its vision is to be the leading global brand for comfortable, sustainable footwear.
Here we have Birkenstock business model canvas. Their main customer segment are people who want comfortable, healthy, and durable footwear, and fashion and eco-conscious consumers. Their value proposition is supportive, long-lasting shoes made with sustainable materials that combines comfort with timeless style. Their main channels are the online physical store, the brand stores, the retail partners, and fashion collaborations.
Then we have the customer relationship, which has a strong brand loyalty community. They have a good customer service and support. They have a good engaging social media presence, and they focus on customer experience in stores and online. And for the revenue streams, the main one is the sales of the footwear, and then we have the sales of accessories, which are like the insoles and the socks. And then we have the collaborations with fashion brands and designers. The key activities Birkenstock has is footwear and its design and production, marketing and branding, supply chain and logistics management, product innovation and sustainability efforts. projects. And then Birkenstock key resources are brand reputation and heritage, property, footbed technology, skilled workplace and craftsmen, and they have sustainable supply chain.
The key partners are the raw material suppliers, the retail partners and distributors, also the fashion collaborators and influencers, and the logistics and e-commerce service providers.
Here we have the Pearson analysis. The objective of the Pearson analysis is to evaluate the Birkenstock's financial performance. Here we benchmarked it with against Crocs, Deckers, Skechers, and Puma. This analysis assesses the investment attractiveness using the WACC, which is 4.51, again, and the IRR, which is 21. Then with this, here you can decide whether it's good to invest or not in Birkenstock today. Then we have the profitability analysis, which here we can see that Birkenstock maintains solid gross profit margins, showing effective cost control and healthy markups. The operating margins are consistent and strong, indicating this efficient operations relative to competitors. Net profit margin is positive and stable, reflecting profitability despite the challenges in 2023. However, the ROE and ROA are low, meaning Birkenstock isn't generating high returns from its assets or equity compared to peers like Crocs or Deckers. In conclusion, profitability is decent, but return efficiency is lagging.
And now looking at the liquidity ratios, Birkenstock shows a strong short-term financial position. So its current ratio stands at 260% in 2024, which means it has more than double the current assets needed to cover its short-term liabilities. This is significantly higher than Crocs, Skechers, and Puma, and just slightly below Deckers. The quick ratio and acid test ratio at 120% and 84% respectively confirm this trend. Even without relying on inventory, Birkenstock can meet its obligations, something that competitors like Puma and Crocs are struggling. So the liquidity is high, it's above the industry average, which reduces risk during downturns. Then moving on to the solvency ratios, Birkenstock demonstrates a stable approach to long-term financing. The debt-to-equity ratio at 60% reflects a moderate use of debt relative to equity. While this is slightly higher than some peers like Deckers, it remains within the acceptable levels. The debt-to-assets ratio stands at 28%, suggesting that less than 1/3 of the company assets are financed through debt. This implies a relatively low financial risk. Additionally, the interest coverage ratio is 4.06, is significantly lower than the peers. While the company can meet its interest payments, this margin is thinner. So in conclusion, Birkenstock's solvency position is acceptable, but strengthening its interest coverage should be a priority to reduce financial vulnerability.
So for the efficiency analysis, for receivables turnover, we have that the company collects payments from customers faster than competitors, which is a good sign. However, inventory turnover is very low, suggesting that product remains not too long. The cash conversion cycle is very long, meaning it takes a lot of time to convert investments in inventory back to cash. In conclusion, working capital management is weak, and inventory efficiency needs urgent improvement. Then, as we all know, WACC stands for weighted average cost of capital. It's the average rate a company must pay to finance its assets. And then, as we can see, here the WACC for Birkenstock is 4.5%, which allows this. This means the cost of capital is affordable. And IRR, which stands for International Rate of Return, is the expected return from the investment. In this case, it's 21.2%, which is high, meaning potential returns are significantly above the cost of capital. This creates a strong value spread, which signals that Birkenstock is generating substantial shareholder value. In conclusion, from an investment perspective, this is highly attractive. Then this is the stock value return. Fair value, yes, sorry. Birkenstock's forecasted earnings per share for 2025 is 2.22 euros, using a price to earnings ratio of 24.35. The estimated fair value of the stock is 68.74 euros, with a current stock price of 54.08 euros. There is a 27% potential increase in value. The IRR is 21.2%, which is significantly higher than WACC of 4.51%, indicating strong potential for return on investment. We recommend buying the stock based on its solid financial fundamentals and strong growth outlook.
For the forecast outlook, Birkenstock is projecting a sustainable growth driven by several key factors: expanding revenues, stable profit margins, healthy cash generations, strategic investment into brand and operations. All of this positions Birkenstock for long-term growth, not only in terms of market share, but also in creating lasting value for our shareholders. Balance sheet forecast 2025. The balance sheet shows a solid financial positions. The company holds a good level of cash and receivables, manageable inventories, and strong equity. Debt is low, indicating reduced financial risk. Overall, Birkenstock is financially stable and well prepared for future growth. Invest in Birkenstock. Birkenstock presents a strong investment opportunity due to solid profitability recovery, operating margins of 24% and net margins of 11%, show healthy growth through real steel catching up to Crocs and Deckers. Strong liquidity. A current ratio of 260% means we're well positioned to meet short-term obligations with ease. Attractive returns. Our WACC is 4.51% and our IRR of 21.2% indicate we're generating returns well above our cost of capital. Manageable debt. A debt to equity ratio of 60% is sustainable, and our interest coverage ratio of 4.06 ensure debt service is secure. Strong global brand. Birkenstock's heritage and growing global demand solidify its market leadership, while operational efficiency could improve, particularly in cash conversions and inventory turnover. Birkenstock remains a compelling investment. Thank you.
Can you go to the figures analysis, please? Format.
I know. Sorry.
Okay. Which one's the best? You recommended me to buy Birkenstock, okay?
Yes.
Which company is the best of this? Because if I see that first analysis, the worst one in Birkenstock.
But it's still a good one.
Yeah.
I mean, you're not gonna say. I mean, maybe it's not the best of its competitors, but I think it's a good opportunity of investment overall. Like maybe know how it's in the competitors, but I think it's.
Okay, you significantly price the share above the current price. How can you sustain that valuation? Go to the fair value.
Fair value? I agree.
So estimated fair value is 68.
68.74 euros.
And the current value?
50.
Why the difference? How did you get to those 68?
With the.
Ya sé, pero no sé cómo. I don't know how to type better.
And how did you get the internal rate of return? Explain it, please.
No pasa la with the formula, no. With the formula, with the actual value,
Okay.
we don't have the dividends, so just do the zeros.
Yeah.
And then this was the formula, the actual value by 1 plus the CIGR of 5 years of the value to elevate it to 5. So the 5 years.
So where's the compounded annual growth rate? Where is it? Okay, it's okay, I can see it there. But where's the compounded annual growth rate?
In the 5th year, this is 100.
No, but how much is it? So like, how did you get to, I get your.
I have the Excel, the CAD.
I just wanted to know what's the number that you took to get to the 1.1.
.212. So
21% growth rate?
Yes. Is the CAGR that we have?
Based on what, on the history? How did you base your, what's the source of that 21%?
Both match stock or match stock match. Match stock.
Okay, thank you very much.
Thank you. Good morning. Today we're going to present our Capstone project, talking about our company, which is Netflix. My name is Maria Romero, and this is my team. So first is the agenda. We're gonna give a little bit of the company's background, then their business model, their differentiators, their competitors, and then we're gonna talk about their financials, their ratios, and finally get to the conclusion if we should invest on Netflix. So about Netflix, it was created in 1997 by Reed Hastings and Mark Randolph. So Netflix is currently a leading global entertainment service that offers a variety in series, movies, and documentaries. So their service is the streaming service, which allows users to watch their favorite shows and movies that are on demand. So the market, global market reach, so Netflix is operating in over 190 countries. which is basically all of them, and it has a diverse audience and interests and preferences that go through all of these countries. And then their mission is to entertain the world through the diverse programs and movies. And then their mission is to be the world's leading entertainment service. And their values are mainly member satisfaction, freedom, responsibility, and innovation. So about their business model, so they have a subscription model which you pay, the customer pays monthly to have access to all of their content. And then in this graph, we can see their revenue distribution. We can see that the monthly subscriptions has an 85% of their total revenue. And then a 10% is advertising, which was introduced in 2022, which is really like new, but it also has a huge impact in their revenue. And also there's a 4% in content licensing, and they're starting with gaming and merchandise, which is small but also a contribution. And so their key strategy right now is to have their own content and create their own TV shows and everything in their content. Okay, so now we're going to be taking a look at the main competitors. So in the pie chart on the left, you can see that Netflix has a percentage in the streaming market of 39.4%. Following is Amazon Prime with 29%. Third is Disney Plus with 24.3%. And then last but not least, HBO Max with 7.3%. Next to the chart on the right, we have all the platforms and then the base prices for the monthly subscriptions and then the number of subscribers. So in first place, we obviously have Netflix. It does have one of the lowest monthly subscriptions, but also the highest amount of subscribers. Second, we have Amazon Prime with $9.91 a month, which second 200 million subscribers. And then Disney Plus, again, the main competitor for Netflix's price in the price range is Disney, but they do have less subscribers with 164 million. And last, the most expensive and also the least amount of subscribers, which is HBO Max. And in the little bullet points, the reason why Netflix, a big contributor, the reason why Netflix has the largest percentage is because of the budget-friendly plans. It has a lot of plans that you can choose from, a lot of original content availability so that it attracts a lot of people, and then their excellent digital and marketing strategy, like I said, was just introduced a couple years ago, but has been really successful for them. Next, we have the key differentiators. We picked Amazon Prime for this one because it's the main competitor in almost all the categories. So for Netflix, the first key differentiator we have is probably one of the most important as well, and what they're focusing on right now, which is the original content that they're creating. They're really trying to focus on getting that for a boost in revenue, which we'll see later. But an example of this can be that in 2023, they spent $17 billion on their own original content. And an example of this can be Squid Games. We've all seen Squid Games, right? Yeah, practically all of us. Okay, well, Squid Games actually generated over $90 million for Netflix when its cost to make it was 21. Next, we have data-driven personalization. So I don't know if in your Netflix accounts you've seen like recommended for you. So based on the stuff you watch, and you have like a little thumbs up and thumbs down. So stuff like that is really important to them. So they want to kind of make your Netflix for you, so it's more personalized, which a lot of streaming platforms don't do that much. Strong brand and market position. So Netflix is really strong. I don't know if you guys have heard me say Netflix and chill. But that, yeah, so that's like one of their things that they kind of heard it and took it and ran with it. So that kind of makes them stand out. So the content focus is the fourth one. And right now they're really focused on just creating content, like video content. And then the fifth one is the binge watching module. So what they do with most of their series, the original content, is they release it all at once. So the viewer can watch it all at once instead of watching it, once every Sunday. Instead of, so it comes out all at once. And then the last one, which just came out, which has had some kind of controversy, is the password sharing crackdown. So now other people in your household can't use your Netflix account. Like if it's not to your Wi-Fi or your IP address where you signed up on the account, it asks you to do a whole different types of verification and stuff like that. Now moving on to Amazon. So Amazon is different in their format because they have a bundled value. What does that mean? That means that when you can buy Amazon Prime, you can also get Amazon Video, the books that they have. There's more variety. Next, the diverse monetization. So in Prime Video, you can rent movies and shows. You can buy them, so that's also different, something different that Netflix doesn't do. And then the content library size. There is a lot more selection of third-party content because Amazon Prime doesn't do that much original content like Netflix does. They do, but not to the extent that Netflix is doing. And then lastly, we have the global market strategy. So they're really focused on their e-commerce and infrastructure for their key markets. Okay, next, we're going to be taking a look at their income statement. So in all of the revenues, we can see that Netflix does have a really strong, steady net income. Operating, all their revenues are really steadily and they keep going up. And this basically shows that they have strong operating margins that reflect efficient on their cost control and monetization of the content. And then, and the red part is the forecast that we did. So with all of that, we basically forecast that they're gonna keep going up and do good. Next, we have the balance sheet. So in all the assets and liabilities, they're all well balanced, as we can see. And Netflix maintains a capital efficiency and has been reducing, so that kind of reduces the long-term debt. And then now we have the ratio analysis. So for the ROE, which is the return on equity, we have a 35.1%, which shows strong returns for the shareholders. And for the ROA, we can see that in 2024, it was 16.24, which also, it shows that they're improved profitability. Thirdly, we have the debt to equity, which it dropped to a 0.63%, and this is actually good because it shows that they have lower financial risk and depend less on debt. And last but not least is their current ratio, which is at 1.22, which this means that Netflix is better equipped to their short-term liabilities. So overall, we can see that Netflix is has made a solid financial improvement and using efficient capital over the last 4 years.
Okay, so now talking more about the peers analysis, we used 4 different streaming services apart from Netflix. which are Prime Video, Disney Plus, Peacock, and HBO Max. Starting, we should say that Netflix is the best of them in terms of profitability ratios. It has the highest ones among them. It's the best in that term. We can see that they have a net income of 22.34%, a gross margin of 46.06%, and well, we can keep going on, but overall, the profitability ratios are the best among the peers from Netflix. Then we have the efficiency, the liquidity and solvency ratios. We can see that they are strong, and the current and quick ratios at 1.22, and they have a low debt to equity which is 0.63, as Gigi explained earlier. We have then the efficiency ratios, which are very, very good. We have an excellent high turnover ratio and a very short financial cycle, which is 3.63 days. Then we have analyzing Prime Video. Prime Video is, as we explained, their most direct competitor, and it can be also shown here in this chart because it kind of is very similar to Netflix, except
Prime Video or Amazon?
Amazon Prime Video.
It's full name.
Yeah, the full name Amazon Prime Video. But the thing is that they are slightly behind Netflix in terms of efficiency. Then we have Disney Plus, Peacock, and HBO Max, which are really in another category because all of them three are not very suggested to invest in. They have really low profitability ratios. They also show poor turnover and very high, long financial cycles. So all of them three have very bad ratios. They're not suggested to invest in. And well, that's that among the peers analysis. We can keep moving on with the stock fair value, talking about the capital asset pricing model, or the CAPM. We can say that based on its data of 130, Netflix is more volatile than the market. 30% more volatile than the market. The CAPM result of 5.83% represents the expected return investors should receive for taking on that risk of the volatility of Netflix. As of May 15, 2025, that is today, Netflix stock is trading at approximately $1,178.06. Estimates are around $1,032.93, suggesting that Netflix is slightly overvalued, around 10% overvalued than the actual price it should have, but there is a potential growth of 31%. Then we go on with the WACC. We can see from all of this data gathered up to get the WACC, the formula as it is. We show the 2024 and what could be the 2025 when the year finishes. We see a 9.55% in the last year, and in this year should be 8.73%, rising up a little bit, taking into consideration last year. Then we have the IRR. As we can see here, the IRR is 25.92%, and since this value is significantly exceeds the WACC, Netflix is expected to generate returns for above its cost of capital. This is a strong signal of efficient capital use. The company is also likely to invest in projects or content that yield high returns, showing they have a strategic strength and growth potential, as I explained earlier with the percentage of the growth potential. Then we have the widespread, that is the operation where you take the IRR and you take out the WACC from it. It gives us 17.36% approximately. This suggests that Netflix is generating a substantial value for every dollar invested, more or less that percentage for every dollar invested.
So going to the risk discussion, Netflix has a beta of 1.30, and as Martin mentioned, the stock is 30% more volatile than the overall market. This means that if the market goes up or down by 1%, Netflix is going to go by 1.3% on whichever direction the market goes. This higher sensitivity implies a greater risk for potential returns, but greater opportunities for potential returns, but also a higher risk in case of market downturns. However, the sector risk for media entertainment, the streaming industry is a highly competitive industry, and it is very sensitive to external factors that they can't control, like consumer trends, subscription churns, which is when people unsubscribe randomly, and content spending. Netflix faces sector-wide risks like rising content costs, increased competition, especially from Disney Plus, who is making a very rapid climb, Amazon and HBO Max, advertising model uncertainty, and especially the fact that the global economic pressure is leading Netflix to become a discretionary spending, which is not necessary for our day-to-day lives. And we can see a beta comparison. Sorry. Thank you. We can see a beta comparison for Netflix, which has a higher beta on the market, and its three main competitors. So, as for our conclusion, should you invest on Netflix? Yes, as of today, Netflix is a very good investment. It has a beta that shows moderate volatility, which offers growth potential without excessive risk and reflects a healthy investor appetite for growth with tolerable risks. It has a high return on equity of 35.1% and a high return on assets of 16.24%. And it reflects profitability and efficient asset use. The WACC suggests that Netflix must generate at least 8.55% to create value, and with a cost of equity of 12%, it has a lot of room to do so. And Netflix's continuous innovation, global subscriber growth, dominance in its original content, solidifies their competitive advantage in a recently very crowded market. And since the IRR is much higher than the WACC, this means that the company is creating shareholder value, and investors are very likely to benefit from future earnings and stock appreciation. So overall, yes, you should invest and buy Netflix's shares. It's good, but warning about that. It should only be a long-term investment, because short-term investments can fall victim of the volatile market of the streaming platforms. But that's not just for Netflix. If you want to invest in streaming or entertainment media, it should always be long-term. Thank you.